Mortgage interest rates surged during much of 2023, contributing to the worst home affordability environment in Canada since the 1980s. Will that change in 2024? For a look at housing trends to watch, let's bring in Robert Kavcic, senior economist for BMO Capital Markets. Robert, thanks a lot for joining us. That's the big question for would-be homeowners. Will affordability improve in 2024? What do you think?
Well, it probably will, right? So where we are right now, we've had house prices across a lot of the country come down 10, 20, 30%, depending on the market. Problem is prices came down because rates rose, right? We saw a dramatic increase in borrowing costs. So from an affordability perspective, we're not at the part of the cycle yet where we're actually seeing any improvement because the two are kind of offsetting each other in a sense. But as we come out the next stage of the cycle, where are we? We're at a point now where house prices are off the high, but we're also looking at rate cuts in 2024 and 25, downward creep in fixed mortgage rates. So we're going to see some incremental improvement on the affordability front, I think. Are we going to go all the way back to where we were pre-pandemic when housing was more or less in line with historical norms from an affordability perspective? Probably not very quickly, but we should at least see a little bit of relief on that front next year and in 2025.
What kind of relationship have you seen historically between interest rates moving down, mortgage rates moving down, either because of the central bank reducing its benchmark rate or the bond yield moving down, and prices? Is there any notion that prices tend to increase more rapidly when interest rates come down?
It kind of depends on the context of the economic cycle, right? So if rates are being cut aggressively because the economy is falling into and then in recession, that's obviously not positive for home prices. If you're seeing rising joblessness and unemployment, you're going to have a world where interest rates are falling and house prices are falling at the same time. If you have something that looks, let's say, a little bit more favorable, where the economy is landing softly, and there's a lot of demand for housing, and central banks are cutting rates back towards neutral because inflation is backing off. And that more resembles the world that we're looking at in 2024 and 2025. Then yeah, you could see an environment where prices rise in reaction to falling rates. And I suspect that by the time we get into the middle of 2024, the fact that we are looking at some rate cuts is going to probably be enough to finally put a more sustainable floor under house prices in a lot of the markets in Canada. Some markets we're already seeing it, but some markets are still struggling pretty hard right now.
To what degree is pent-up demand a factor? You note that affordability is at its worst level since the 1980s. That would certainly shove a lot of would-be home buyers to the sideline, and they would represent pent-up demand.
Yeah, I think there's a lot out there, not only from households within Canada, but a lot of the immigration flows as well are building up quite a bit of pent-up housing demand. And look, the market right now is just not clearing very well, right? Because you have sellers that are cutting prices a little bit, but still kind of hanging on to prices that maybe existed 12 to 18 months ago and don't want to let properties go. But on the flip side, you have a lot of buyers out there who are, a source of just legitimate physical housing demand, but they can't afford prices that existed 18 months ago. They can't qualify for mortgages at prices that existed 18 months ago at these stress test levels. So you have a really wide bid-ask spread in the housing market, almost in the sense that we're just not seeing the market clear and volumes are pretty low. But I suspect that you have some combination of prices coming down, which they are, and mortgage rates eventually coming down, which we think they will. That'll allow the market to clear better and probably improve affordability a little bit, bring buyers back in the market, and you'll see conditions pick up through the latter half of next year.
What about people who buy homes, or in particular condominiums, for investment purposes? We heard that the stresses in the mortgage market were prompting a lot of those investors to head for the exit. So what do you see ahead for real estate investors?
Well, it's still very quiet on that front, I would say. The investor class has more or less left the market. And I think of it from the perspective of an investor. If you're a fundamental cash flow driven investor, you're looking at cap rates that maybe were 3.5% or 4%. Made sense when mortgage rates were 1.5% from a cash flow perspective, or even the perspective of building equity over time. But you very quickly reset mortgage rates to 5.5%. those cap rates don't make sense anymore, right? That cash flow dynamic doesn't make sense anymore, especially when you have risk-free GICs at 5 and you have dividend yields across a lot of the equity market at 5, 6, 7%. So from that perspective, we need to see more adjustment, and cap rates can adjust a number of different ways. Prices can come down, which they are. Rents can continue to rise, which they are. And longer-term interest rates can come down, and we suspect that will continue to happen through 2024. So eventually we'll find a balance again where maybe it makes sense for fundamental investors to step back into the market. Right now, it probably doesn't. And the other side of it is, if you're not a fundamental investor, what we have seen a lot of was more speculative type of investor, where you were buying pre-construction projects or buying houses to flip. Made a lot of sense when prices were rising at 20 or 30% per year, but you take away the expectations of price gains, and very quickly you kind of scrub out that whole class of investors. And we're not seeing them right now at all.